What's up, guys? So in this video, we're going to be going over the actual model that I'll be teaching within this course and how to actually trade it. This is a pretty mechanical model, meaning that if you are able to follow rules and you are good at following rules, you will most likely be good at following this strategy and actually executing it properly. Um, so without anything else being said, we can just kind of go into what it is. So without actually going into what it contains or what you're looking for within the chart, I want to go into kind of a ideology that I have behind all of my trades. So behind all of my trades, I have three parts of every single trade that I take. I have the narrative for the trade, I have the reasoning to actually take the trade, and I have the respect or the disrespect of my side or the opposite side. So if we drag this back up here, the first part, meaning the narrative of our trade, is going to be a liquidity sweep. So I'll add that in here. So first part of the trade is going to be a liquidity sweep. Second trade, the reasoning, is going to be rather our inverse fair value gap or a market structure shift. Now the third reasoning is going to be the respect or the disrespect of our side or the opposing side that we're trading against. So that could be the same thing as the reasoning. It could be an inverse fair value gap getting created. It could be a market structure shift to our side of the market. It can be any of these things. So just to add that on there, that is essentially my three reasons to take a trade. So going to the model, now let's get started off. So the first thing that you're going to be looking for when you're trading this model is a liquidity sweep off of 15-minute plus liquidity. So what do I mean by that? On every single time frame within the market, hopefully this stays, with every single time frame within the market, there's liquidity on every time frame. There's liquidity on the 1 minute, 2 minute, 3 minute, 5. There's all of these time frames. There's liquidity, even on the second time frames. So what I'm essentially looking for as the first part of the model is I'm looking for a liquidity sweep of a high or low on the 15-minute time frame or above. So this means that I'm not looking for highs or lows on the 5-minute or anything underneath it. I'm just looking for highs or lows on the 15-minute, 30-minute, 1 hour, 4 hour, whatever time frame is above the 15-minute time frame. So just as an example, if I was marking out 15-minute highs and lows, we have this 15-minute low, we have this 15-minute low, this one, oh, it's not selecting. All of these, we have all of these highs or lows that are on the 15-minute time frame, and these are what I will mark out as liquidity. So if we go back over here, mind you, I'm looking at those liquidity sweeps, but they have to include a PD array or another confluence. So what do I mean by a PD array? That can be a fair value gap, inverse fair value gap, order block, breaker block, volume imbalance, balance price range, or even just a wick of a very big and prominent, outstanding wick on the chart. You'll see a lot of, like news wicks, for example. Those are the types of things that you can use towards a confluence. I find no reason to teach them within the course, as that is literally just how candles form. Wicks are forms of support and resistance. So, like I said, we're looking for a liquidity sweep off of the 15-minute or above time frame with another confluence. So it can be a liquidity sweep inside of a fair value gap. It can be a liquidity sweep inside of an order block or an inverse fair value gap, a breaker block. Any of these confluences down here, it just has to be a liquidity sweep within any of those. It can be a daily liquidity, or it can be a daily fair value gap, a 4-hour fair value gap. It can be any time frame PD array, but the liquidity sweep just has to come from the 15-minute time frame or above. So for the next part of the strategy, we will wait for an inverse fair value gap or a market structure shift created on the 1 or the 5-minute time frame, or 1 to the 5-minute time frame. So you could use the 1, 2, 3, 4, or 5-minute time frames, whatever one that you find suits you best. So like I said, we get the liquidity sweep inside of a fair value gap or whatever confluence we use. Oftentimes, it will end up being a fair value gap that you'll get a liquidity sweep inside of. So then we wait for our inverse fair value gap or a market structure shift on the lower time frame. Once we get that, we can rather enter the trade as soon as the inverse fair value gap is created, or we can wait for another PD array to be formed on the 1 to 5 minute time frame. So what that means is, say we get the inverse fair value gap, or we get the market structure shift, or we get both. What we're then waiting on, if we are not already in the trade, we will wait for another confluence to be formed. So if we're looking to enter a buying position, after we create a bullish inverse fair value gap, we could wait for a normal fair value gap to be created to take our trade out of. After that happens, or if you're not in the trade already from the inverse fair value gap creation, then you can wait for a respect candle out of that PD array or out of that confluence. So if you have a bullish fair value gap, you would be wanting a bullish candle out of it. The same time frame that the fair value gap or confluence is selected on, you want a bullish candle out of that same time frame. So if you're entering off of a 1 minute fair value gap, you want a 1 minute respect candle out of it. If you're entering off of a 5 minute fair value gap, you want a 5 minute candle out of it, a respect candle out of it. And respect candle meaning if you want to enter a buy, you want a bullish candle out of it. If you want a sell, then you want a bearish candle out of the PD array. So that's essentially the entire model. It is incredibly simple. You just stick by these rules. On average, I would say this has around a 65 to 75% win rate. I tested this over 2 years, and there was a 76% win rate overall. Over 200% was made over those 2 years, and the best month was, I think, an 82% win rate. So it has a good win rate, but you need to stick to the rules. You need to actually follow the mechanical aspect of it. And also, everything in trading comes with a little bit of intuition. You're not just going to know everything instantly, and you're not just going to be able to follow a model and instantly become profitable. But this is a 100% proven profitable strategy, and if you are able to maintain your discipline and your emotions and your emotional control, then you can definitely make money with this model. So now that I've went over that part, I'll go over the rules. So for this model and for this trading, you're going to be targeting a 2 risk to reward or a 3 risk to reward. If you're targeting a 3 risk to reward, then you want a partial half or more of your position at a 1.5 R. So this is essentially securing you profit if you wanted to go for a higher risk to reward. If you're going for a 2 risk to reward, you don't need to partial. If you want to, it's open, and the system can still be profitable with it. But me personally, how I manage my trades, if I'm going for a 2 risk to reward, I'm just holding the full position to a 2R. If I'm going for a 3R, I will partial at a 1.5R, and I'll leave the rest running. So very straightforward with that. It's kind of the same way as EP's kind of system with the fixed risk to reward, so it makes it a little bit easier instead of targeting actual points on the chart. So then you're always going to set break even at rather a 1-to-1 or at your first take profit. So that could mean if you don't like to set break even, you don't have to set it. But if you're going, for example, if you're going for a 3R and you're partialing at a 1.5R, after you've partialed, you always want to make sure that you have a break-even stop loss. After you've taken money off the table and you've taken your piece of the pie, you want to make sure you are risk-free. Now, I set break-even at a 1-to-1 just because that's what I prefer. It keeps my win rate a little bit higher, and most of the time, if my trade comes to a 1-to-1 and ends up reversing back to break-even, more likely than not, it just ends up being a loss. So that's why I personally set break even at a 1-to-1, and I just go for 2R most of the time. Another thing to note, SMT makes nearly every single trade higher probability. So if you're looking at a trade and you don't have SMT and you're not very confident in it, that may be a reason to stay out. SMT happens all of the time in the market. So if you don't have it, that's kind of a signature already of low probability markets because everything is in sync. Nothing is decorrelated and nothing is supporting more strength to another, right? If everything's correlated and everything's moving essentially on the same axis, then nothing has enough strength to give another index strength. I like to see SMT in pretty much all of my trades because it's just a very strong directional bias tool. It helps me get a very good understanding of where I think the market's going to go. Now following on to this. Now, if you take a loss with this model, it's really easy to trick your brain into thinking that you're doing something wrong. Or if you take a string of losses, it's really easy to think to yourself that you might be doing something wrong. Maybe there's something you need to change, or, whatever it may be. With this model, there's specific reasons that you should care if your trade lost or not. Because we are simply just following this mechanical part up here. We're just going on the 15-minute time frame, looking for those highs or lows. Make sure it has a PD array. Inverse fair value gap on the 1 to 5 minute. And, just wait for all these little PD arrays. Everything that goes into this model, this is alone just something that you are following rule-based. This is not a lot of intuition behind it. There's going to be intuition in seeing the setups and, choosing out prominent liquidity or whatever. But in terms of this model, it is very straightforward. There's not a lot of reasons that you should be mad if a trade loses, but there is few. So if you lose your trade, and let's say, for example, there was equal highs or equal lows above or below you, that can be a reason of why your trade lost. And that's something to document, because you might want to look into that and see, okay, maybe I don't want to take a trade if it has equal highs above or below. So it's just something to note. Most of the time, if I do see equal highs above or below me, I will most of the time stay out of my trade. I'll wait for them to get taken, and then I'll look for a setup. I'll then look to execute, because then I have a higher chance of not just getting my stop loss hit and then price going directly in my favor. So that's one reason that you should care if the trade lost. Now, another reason is trading into SMT or trading into fair value gaps. So if you enter and your entry is essentially right directly into SMT or the opposing side, meaning let's say you're in a selling position and you enter and all of a sudden there's bullish SMT and then your trade loses, you can understand that that bullish SMT is most likely what made your trade lose. So you can look at those trades and say, okay, maybe I shouldn't trade into SMT, or maybe I shouldn't trade into, a fair value gap underneath the 5-minute time frame, or something along those lines that will kind of just help you get a better reasoning of why it lost. And it'll be very clear with those things because they are PD arrays. They are things that we are actually using in our trade. So if they are being used against us, it's just a clear reason of why our trade lost. And mind you, everything in trading is probability. So you don't want to be trading against equal highs or equal lows. You don't want to be trading into SMT or into fair value gaps. You want to be following your side of the market. You want to see disrespect to the opposite side, and you want to see respect on your side. So, like I said, there's very few reasons that the trades, that you should be mad that a trade loses. But if it's any of these reasons or news, these are things that you can note down for when you start trading this model yourself. So now that I went over all of this, I went over the 3 parts of the trade, how to actually trade the model. Now we can go into some actual examples. So got this one right here. Yeah, okay, so I'm not even going to bother going onto the higher time frame. Right here, this is a 15-minute low. You know what? I will. I didn't know if it was going to send price back. Okay. So right here, we have this 15-minute low right here that price formed. We also have this 15-minute low and this 15-minute low. But we can clearly see these were already ran before. So this right at 9:30 or right around 9:30, this was the low that was getting swept. Now, what do we also have with this? We have this huge abnormal wick right here. Now, like I said, I find no need to teach this within the program because this is just, it's simply how price moves with candles and bodies and wicks. When you have a big abnormal size wick like this, you have to remember this was support. The reason this wick was created was because this was a big push of support. So what I usually do when I see these big wicks, I'll mark up to 50% of the big wick. So if I just do it from right there to right there, we can clearly see this line is the 50%. I expect if we're going to have buying pressure from this wick, I expect it to come from the bottom half. So like I said, the 50% mark of this entire wick. So that would be our second PD array, or our second confluence with our trade. So we have a 15-minute sweep. We have this gigantic wick right here. We have the 50% of it. Now if we go on to the 1-minute time frame, if I can find where price is at, go back a little bit more. We can clearly see on a lower time frame, right? So what did we get first? We had our 15-minute liquidity sweep, which is this red line right here. I usually have my stuff color-coded, so any type of PD array or confluence that I use will usually be blue, and then any type of liquidity sweep that I'm taking will usually be red. I like to color code stuff. It just helps better with the brain. Along with volume imbalances, I use them as orange type of thing. So right here, other than that though, we got this 15-minute liquidity sweep right here. We have this big 50% mark of the big 15-minute wick, like I said. And what do we do, right? Price comes into it, sweeps liquidity, and forms this bearish fair value gap. Once price closes above this bearish fair value gap, you could have entered right here. Now, mind you, if you waited for a PD array, meaning that you waited for possibly this little fair value gap to get tapped into, you would not have caught this trade. You would, I mean, technically you could have from, this wick going into it or whatever, but you would not be in this trade. If you were waiting for this PD array or this fair value gap, you would not be in this trade. But if you entered as soon as this inverse fair value gap right here got closed above, then you would be in this trade. And what you do is you can have your stop loss, at this low. What I like to do is when I see a bunch of wicks kind of bunched up like this, I'll kind of do it at like the 50% of all those wicks, or maybe like the 50% of just one of these individual wicks, like right here. I could do it at around the 50% of this right here, because this is the inverse fair value gap candle. So I could have set, maybe stop loss like right there, 50%. And then what do? Close above, target 2R, boom, target hit. If you were to target 3R on this, you would not have gotten your full target. You would have gotten stopped out break even with a 1.5R partial right here. So that's just one example of the model. It's very simple, very mechanical. You're just following steps. Like I said, a lot of these trades, sometimes they'll just run without you. Sometimes it will just close above the fair value gap, or, close past the fair value gap, and it will start running. So that's something that you also need to find within your own trading, within your own back testing, to find if you like to enter when the candle closes above, or if you like to wait for those extra confluences. It's a preference thing. I can't tell you what to do. I cannot tell you to wait on the fair value gap or to not wait on the fair value gap, because price doesn't tell me those things either. I have to go into the market and I have to decide, am I going to enter as soon as this closes above, or am I going to wait for another PD array or another confluence? You have to actively make those decisions, and you have to go through your own testing, your own back testing, to see what you prefer. So here's just one simple example, just very simple. Liquidity sweep, another PD array, we get the inverse fair value gap, it gets closed above, and you enter. So there's one example. Go over here to the right. We have another example right here. So what do we have? You can see this is a 15-minute high. We have a 115-minute high. It got swept right here. We come down, push down, push down. There was technically an entry over here. It was just break even. No point in me really marking that up. You got a entry underneath this bullish fair value gap right here, creating this inverse, and then it would have hit your one take profit and then stopped you out break even. So, is what it is. Now, with this one right here, we can see this is a 15-minute high, and we have a 15-minute bearish fair value gap over to the left. Well, actually, I'll go on the higher time frame for this one. Right here, we can see this bearish 15-minute fair value gap right here, and we can see over to the right See price retrace into that along with these 15-minute highs right here. Scale back down to the lower time frame. So right here, we can see we swept out this liquidity right here, and then we created these inverse for value gaps right here. So we created one and we created two. You could have entered when price closed underneath right there, had your stop wherever you had your stop loss. It would have been a break-even trade or a profit trade regardless, just depending on where you had your stop loss. But regardless, we're not focusing on that position. Right here, we can see we created these inverse for value gaps, and then we created a bunch of bearish for value gaps with it. Once price we also created equilibrium. Got to mark that up. Right here, we create equilibrium. We create a bearish for value gap, bearish for value gap, bearish for value gap, all of these bearish for value gaps. And then when price finally retraces back past equilibrium, after creating these inverse for value gaps, we retrace back, and what do we retrace into? Directly into this 1 minute for value gap right here. After price gives a bearish candle out of that for value gap, you could have entered this trade. And now, you might ask yourself, well, we had this entry down here, right? Off of this bearish for value gap, right? Right here? Yes, there is. But you need to realize probability. If this move has already been made, and we already just took out these lows, why are you going to want to enter, right, without having an actual pullback to continue the trend? Mind you, this is a completely valid loss to take. If you were to have taken this trade, it follows the model, and it is completely valid to take. It's okay. A losing trade like this, it's okay, because you're not always going to win. But you have to think of things in a probability standpoint. So in this market, it would have been higher probability to let price return back to an inverse fair value gap with a normal fair value gap overlining it, or otherwise known as a BPR. We have a BPR right here, one of the strongest signatures in price. So we also have the normal fair value gap. So it would have made a lot more sense to enter here on this fair value gap with maybe like the stop above this little minor high, and to go for, 2R, 3R, whatever you were to go for. It would have made a lot more sense than entering something right here. So that's just another example. It's very, very, obvious. We have the liquidity sweep. That's our narrative. We have, reasoning, which would be these inverse for value gaps getting created because this is a sign of disrespect to the opposing side. And then what do we get? Retracement back, and we get respect on our side of the market out of this bearish for value gap. Could have entered right there and targeted down here. Even if you entered here and you had your stop, wherever it may be, you still could have re-entered this trade and you could have made your money back. This is why the risk to reward is important. This is why you need to follow the mechanical rules. Also with the partialing, you don't want a partial if it's not at least a 1.5R. Reason being, you don't want to just make back half of your investment. You want to at least make 0.75 times of your investment, or at least, 3/4 of it. It works a lot better with the risk to reward. So there's obviously another example right there. Go further over to the right. Got one more over here. So right here, what do we have? I'll go in the higher time frame. We have these 15-minute lows right here. We also have this 15-minute for value gap, but on a higher time frame, on even higher time frame, we have this 1 hour for value gap right here. So if we go back to the lower time frame, scroll over, we can clearly see price right around 9:30. And mind you, this is also within a time macro. Tell you guys those. So this is the 9:50 to 10:10 macro. So we can expect an expansion in this area. So what does price do? We come down, sweep out this 15-minute liquidity. What do we also do? We tap this 1 hour for value gap right here. What do we do next? We create this inverse for value gap right here on the 1 minute time frame, also creating a bullish for value gap on the same candles, essentially. What can you do? Get a bullish candle out of that for value gap, stop underneath the low, or wherever you want to put that. Target 2R, 3R, whatever targets you want to go for. I will say that if you wanted to go and actually target liquidity itself instead of a fixed R, you could, but that is also removing a part of the mechanical aspect of the model. So if you're not going to get the same results, don't, well, honestly, don't expect the same results if you're not going to do the same thing and follow the same mechanical model. You need to be able to adapt and expect what is actually realistic to your trading plan. So, very simple. The model is very simple. It is very mechanical, and if anybody has any questions with it, obviously I'm open to answering them. I'm open to helping. Just make sure you stick to the rules, and if you lose a trade, don't be mad at it unless one of those reasons that I listed at the start of the video is there. So I hope that helped. I hope that this is going to give you guys a good understanding of how I trade, how I execute, and if you have any questions, just let me know.